We have Ankur Bhandari, who is the head of supply chain finance for Bizongo, a leading LSP that has been working closely with NBSC partners to enable credit for the ecosystem, and would love to get the view of an LSP of what changes and uh, uh, what could be the challenges going forward, or what could be the opportunities going forward for LSPs. We also have Sushil Shastri, who is the group product manager for our payment gateway solution, bringing in the view of how this impacts PAs, how this impacts the ecosystem on usage of PAs, basically, for repayment of loans, right? So, Sushil, welcome to the session as well. And I wanted to request, before we jump into the set of questions, I wanted to request the attendees. We have an overwhelming number of people who have signed in, and I'm assuming the number will also keep increasing. So, I'm requesting the attendees do put in your questions early on, because I do aim to take as many questions as we can during the session. Because earlier a few times we've had to miss out on questions, so would love to take the questions as we go. So do keep putting in your questions in the Q&A chat, and I will take them up as much as possible, right? So starting off, I think FAQ has clarified a bunch of things. It has also helped with the definition of what a digital lender is, or who a digital lender is, right? So starting with you, Pushparaj, wanted to get your view. First of all, does the fact that a digital lender is also somebody who could be having a hybrid mode of lending, right? Does that change anything for the RE ecosystem? Are there REs who are earlier considering themselves to not be in DLG, right? So what is your view on that? And second of all, what are the most important points? Of course, all of the points are relevant for REs, but what are your key points that you've taken home, from the FAQs? Would love to get your views on that.
Yeah, hi. Hi, Aditi. Thanks for inviting me on this webinar. Thanks a lot. So in fact, I'll give you a bit of view about the REs altogether and the impact of the digital lending guidelines. Let's say if you look at the REs in the current ecosystem, we have a lot of REs who are pure play NBFCs having a brick and mortar stores, and they are sourcing the business as usual for last 10, 20 years. They still fill up the forms in hard copies, process a loan, and then take it up with the customer. And then we have REs who are who might not have so much of brick and mortar infrastructure all across, predominantly operating through the apps in terms of the equation of the customer. Underwriting, yes, centralized underwriting, plus the servicing his customers is through the app altogether. I think when you look at the overall scheme of things, the DLG guidelines are applicable for all those REs who are, let's say, sourcing the business themselves through the digital mode, and well as who are, let's say, having a partnership with LSPs who have a direct interface with the customer through the digital modes altogether. So I think the impact is larger, and it is more to do with the compliance that the RE is in, and it is more to do with I would say it's more to do with know your customer in actual sense for REs at this stage of time. So that's one of the things. A couple of things that you also said. What are the key things which I should be talking about right now? I would say for REs, two things which have come up. One is very similar to the insurance, which is called a cooling off period. I think that's something which is a game changer altogether for the industry. And then the second thing is the display of the APR, I would say, to the end consumer. Is something which is a game changing and which will bring in lot of compliance and diligence at the REs and as such at this point of time.
Understood. And while the DLG came, I think sometime in September, if I'm not wrong, post which there was a period where REs were given a time to kind of comply, right, for new for existing loans, actually.
Yeah.
So after the FAQ, do you see a similar sort of bunch of REs who are having to change things because they interpreted the DLG in a different manner, or do you not see that? I mean, was most of the thing evident to REs, or was some of them surprising when you saw them on the FAQ?
I think most of the things were evident. Underlining factors were from day one was that you should be pretty clear to the customer as to what the APRs are for the customer at the end of the day. How, when it has to be displayed to the customer is something that RE has taken the call. Two was cooling off period was, I think, is something which people are a bit surprised of. Uh, the third thing which had been in the discussion for a larger period of time, which has been one of the disruption altogether, is the flow of the funds. So I think the larger thing in place, bottom line is the flow of fund has to be from RE to the customer's account and from the customer to the RE's account. I think that's where a lot of disruption has come in terms of creating the infrastructure by the RE altogether, and then getting into re-agreements with the LSPs with whom they are working on, right? So I think that is one of the things which has taken a hit on the logistics, and all these NBFCs or the REs, we as such at the Northern Rock also had been largely working on the logistics to meet the third point, which was the dispersal to the customer and the back altogether to the REs. Barring for the few loans which are like supply chain finance also, wherein obviously the payment has to go to the seller at any point of time. It doesn't have to go to the customer. But if you look at the digital ecosystem and where REs were playing a larger role along with LSPs were predominantly end consumer driven loan, which was more for the consumption, primarily a PL and BL kind of loans altogether. And I think that's a welcome change, and it requires us to do a lot of work. And I think we have, and all the REs predominantly must have used their time to come up the curve and set the infrastructure right.
Got it, got it. Thanks so much, Pushparaj. And coming to you, good. Again, while the FAQs, the primary consumer of the FAQ is supposed to be the regulated entity, but the LSPs have a big role to play in digital lending, right? There have been a few pointers, which are specifically impacting LSPs. So, from your point of view, or from an LSP's point of view, what are those key things that are important in the FAQ, that you have taken home and that you think that the other LSPs should also basically pick up and accordingly figure out how to be compliant, how to sort of ensure that, they have that in place? Would love to hear from you.
Sure, Aditi. So I think as rightly pointed by Pushparaj, I think on an LSP side, the bigger challenge was on the fund flows piece. Predominantly, the LSPs are being considered as partners for sourcing leads for them, or to some extent do some amount of outsourcing of the activities like bank statement analysis, or probably a GST analysis or financial analysis, and so on and so forth. I think the larger picture of an LSP is also towards playing with the data or curating the data, which helps the lenders to get a final decisioning done in a better way rather than relying on those data which are historical, right? So today, just to give you an example, LSPs are not really limited to distributions or getting a qualified leads or digital onboarding and a customer experience. The larger picture lies towards the transaction data, which is again in benefit of the customer. Getting a real-time transaction data view through an ARB integration, through a real-time auto placements, knowing what kind of product will sell in a particular PIN code. I mean, to that level of extent is where LSPs may move forward or are moving forward in that sense. Further, typically towards the supply chain finance or a trade finance kind of an LSP enabler, the entire flow from say PO to invoicing to disbursals and the repayment reconciliations, tracking of the movement of goods, again digital collections. So these are the kind of goodness that an LSP brings in for a regulated entity. Now, to complete this circle, in order to get visibility of the entire flow of a transaction, it becomes very essential for an LSP to know the transaction details as well. As in, when is the money going out and when is the money coming in. Largely, I think the previous decisions or the current decision of RBI, wherein the transaction has to happen between only the borrower and the lender, this is somewhere, I think, restricting an LSP to get that insight of the data. Again, there are some workarounds on those things, but largely it is still a gray area, I would say. So these are the kind of, I think these are the kind of decisions which has some or the other way affected the LSPs in terms of creating a robust picture for a customer or for a borrower to avail the right amount or choosing the right lender for that matter and scale up as business. So I think the kind of tools that currently LSPs have or they can have in future plays a very important role in terms of financial inclusions or in the industry itself.
Absolutely, Ankur. Thanks for highlighting that. It's super important. Right now when this conversation is going on, sometimes it almost feels like there is a vilification of LFPs, that they should not have control, etc. But maybe that's because there are fringe cases where, undue control or backseat driving was happening. But overall, if you look at the net impact LSPs have brought into the lending space, right, it is a highly positive net impact. So it's really important that, all of us, all the entities work together to enable this further, right? We do have a bunch of questions coming in, but I'll, ask one question to Sushil and then we'll start picking up the questions. Sushil, let's talk about the role of PA, right? When the DLT came out, our interpretation always as the PA has been that our job is that of collections. We are, PAs are going forward, there will be regulated entities. So the job of PA as a, repayment entity or collection entity should not be construed as a third-party pooling, right? While that has been the case, there was still a lot of debate around it because it was not very clear in the DLG, right? Now, it's actually good news for all the entities that it is very clear that PA and the capacity of PA are allowed to be, used in the repayment flow, right? There's again some confusion around the disbursement flow, but let's start with the repayment piece first, right? So on repayment specifically, right? What is it that the lenders need to know? What do they need to know about using PAs? And is there any change that we've had to do as a PA or, PAs in general have had to do from a product standpoint to enable, repayments via PA?
So thanks, Aditi, for that question. I think at second, what Pushpraj and Ankur were just speaking about it, I think there were some gray areas, and specifically in PA's context, it became even more difficult because without having a proper flow and it actually put a context like somehow RE had to figure out everything without an LSP or a PA, right? And now with this new notification, at least one part is clear where, PA are an official moving a source for moving funds from one account to another. So to that extent, I think we'll be the bridge between LSPs and REs to a great extent. Like, and some of the concerns which Ankur had in terms of, hey, if they didn't have to wait to make customers pay or take repayments, that part has been clearly defined now, which is a great news. So from a product standpoint, I think the second part of your question was if we have to do any changes or what are the things that lenders or LSPs need to know. So we already have models in terms of where we were operating in a certain fashion where we have a certain contractual agreement. So there are a few models where, RE becomes our merchant and LSP becomes a facilitator or a DSP in that context, where the actual fund flow is happening between an RE and a customer. At least the repayment is collected from customer directly into PA's account and directly disbursed into RE's account, right? To that extent, RE's role is very clear that they are able to meet the requirement of compliance. And similarly, LSP is not touching the funds. They are meeting also the same requirement. And since PA's the bottleneck till before the FAQ notification, that has been clarified. So that's one model. And even going further, I think if we look at co-lending models and such new age things that are coming up, we do have more optimizations, or let's say some kind of customizations here in terms of making sure all these regulated entities and LSPs can work together with PA to create a craft a customer experience, which are super importance here. So that we are ready with from that perspective. So and in a nutshell, I think it's been a great news for all of us in terms of PA. Somehow we know kind of thing has been set in stone now. The PAs can be really involved in taking money, and that's a great insight. And second thing is, we have already some models, and we'd definitely like to get more feedback from REs or LSPs to really see if there are any tweaks to be done, and we'd be happy to engage with them and figure out all the nitty-gritties of the problems. But overall, we have the solutions to cater to these problems now.
Great, thanks a ton, Sushil. I think even from a perspective of in-app subscriptions, right? While a lot of lenders, many lenders prefer having a direct settlement, but then there are a lot of lenders that work on the model where the money passes through the aggregator, which again is kosher, right? Same applies for virtual account-based repayments as well. So I think that sort of simplifies the process a lot, I would assume, because a lot of these things, the PA exists to make life simpler, I guess, for lenders and for merchants in general. We'll start taking up a few questions. There are a lot of questions, so I'm not sure if we'll be able to get everything answered, but we will try to pick up as many as we can. So, and some of these might be, questions that we may not have the exact answer, but we will try our best as a panel here to take them up, right? So, there's been a bunch of questions which I am collating, which are asking about what does the word control, direct or indirect control, mean when it talks about flow of funds between the bank account of borrower and lender in a lending transaction, right? What is the interpretation? What does that exactly mean? So I'll just start off with, from a PA standpoint, what an interpretation is, but then after that, would love to get to hear from Pushpa and Ankur on the LFP and NBFC interpretation also, right? So for us, it's very simple. First of all, the fund movement has to happen to a lender, right? Which means that the settlement account cannot be that of an LSP. It always has to be that of the NBFC. This, of course, is different in case of co-lending, where if, it is an originator and a lender, then it's a co-lending escrow where the money goes into, right? So then the originator, of course, can have certain control because they are also themselves a regulated entity. But in hundreds, cases, money has to move into a lender. And for us as a PA, the merchant on record has to be the NBFC. We have to be aware who the lender is. You have to onboard the lender, get the KYC of the lender, because at the end of the day, the ultimate liability lies with the lender for the repayment of money, right? So that's the, PA point of view. But would love to hear from, Push, what is your view? What is your interpretation? The word direct, indirect control, of course, again, highlights that backseat driving cannot happen. But what does that, from a business standpoint, how is that interpreted at your end?
Yeah. So look, I would like to step back and go to the genesis of the digital lending guidelines altogether. Keeping in mind that I had been in this ecosystem for some time now, was a part of players who were playing a front-end role. Though I was part of REs, but they were more like LSPs as such in terms of sourcing of the business and giving the service to the customer. I think if you look at the genesis of the digital lending guideline, why RBI has come up is a lot of complaints going to RBI from the customer about the fact that they don't know who their lender is. I think, so let's say if I have a consumer, I've taken a loan from a platform X, or let's say a LSP which is X, and then at the back of LSP there is a lender Y, and many a times I as a borrower was really not aware who the lender is, who the Y lender is altogether. I think that is something which has created a lot of issues. So if you look at all those balance sheet providers as such, when these things evolve in last 5-10 years altogether, and we got a lot of balance sheet lenders coming up, partnering with the front end, let's say LSPs altogether, I think the issue was more to do with the customer service and the collections. And that's where a lot of complaints started coming in when REs got involved themselves, getting into collections, started reporting the customers' DPDs to the bureaus. And then suddenly customers knowing that, okay, they have taken a loan from Y, and then they are really not aware that they have taken a loan from Y, right? I think those are a lot of complaints which has gone to RBI, and that's where they have worked on the first paper which came out. I think that's where I think when I'm as a borrower, if I know that I'm getting my money credited by account through Y, I know who is somebody who is giving me a loan. Similarly, if you go back to the sanction letters and all those things, so I think control, when it is talked about the money flowing from RE to consumer's account, is not to do with the integrity or the capability of the LSP involved, right? It is not to question their integrity of where the funds are going altogether. It is more to do with the end consumer and the lender as such. So it's all about know your customer, and for the customer, know your lender as such. So I think it's more to do with that rather than tightening the screws around the LSP players, which Ankur rightly pointed out that they add a tremendous value to arrive at a lending exposure on the customer as such. And these are the values that they typically end up adding is like, you won't end up knowing by the lane, by the street number about the repayment history of the customers if you're working closely with the LSP. So tremendous amount of value. So it's all about customer knowing who their lender is. I think that's my interpretation is as such.
No, absolutely. Thanks so much for that. I think, it also, in one of our earlier discussions we had in another webinar, a similar point had come up. And I think what, the panel had talked about is that we should remember that this is also helping sort of weed out the wheat from the chaff, right? it's important to understand that this is meant to be to enable sustainable growth
Absolutely.
for NBFCs and for LSPs and, the ecosystem. Making sure that everybody understands that spirit is important. Of course, whenever there is feedback that we want to give back to the regulator, that also should be done. I think that's what the community did right after the DLG came out, which is why an FAQ sheet has also come out, because there was feedback and there were questions from the overall ecosystem. Coming to Ankur, so there is one question which is, it's in everybody's mind. So let's sort of tackle it and see what is everybody's interpretation. So FLDG is still not addressed even in the FAQ, right? It is still a gray area as per current interpretations. So what is your view on this? And what other models do you think RE and LSPs can think of? I mean, in the long run, do you see, this part I'm adding to the question, but do you see LSPs also becoming more, going towards becoming regulated entities themselves and going into co-lending, or do you see them carve out a niche here while continuing to be LSPs? What is your view on this point?
So I think FLDG still largely remains a very gray area. Clearly, the synthetic securitization was not now allowed, which could give lenders leeway that since they have the security to the extent of the default ratio that they envisage, and that is pretty much covered by the FLDG. So there are two problem statements with this. That number one, you are not catering to the kind of customers who are actually in need of money. Number two is you are ending up lending to some people who may not be credible enough to get that loan, right? So that's a point which RBI clearly made, that FLDGs are something has to not to be considered as a securitization for any lending that can be done by the regulated entity. And I think by structure itself, RE is supposed to do the risk assessment. RE is supposed to take the risk on their books rather than a third party like an LSP or a marketplace coming in and giving such kind of securities to lend those money, right? I think to be on the other side, when I think from an LSP side or from a marketplace side, typically into the supply chain finance, wherein the repayment is guaranteed by the marketplace or repayment is guaranteed by the LSO or LSPs. I think there should be some carve out around the understanding that since the risk is not being taken on the direct borrower, the risk is somewhere taken on the anchor or the marketplace. So technically, the risk assessment has been done. It is not something which is a very a gray area or a black box that the risk assessment is not done at all. Now, whether to take an FLDG as a standing point to start any transaction with any of the anchor is certainly not the idea which RBI is currently moving to. Further to this, I think with the given insights given by the LSPs, by the marketplaces in terms of the volumes or the terms of the visibility of the invoices and POs and all those things, some or the other way, these marketplaces or these LSPs are trying to make sure that the FLDGs just seems to be more of a standing point, but the risk assessment is again cleared by these kind of activities or these kind of data inputs given to the regulated entities.
Understood. Thanks, Ankur. I mean, that's a pretty straightforward answer. Thanks for giving that, because I think this is again always been a point which has come up time and again. While RBI hasn't directly addressed it, I think the writing is on the wall that FLDG, unless you're talking about a co-lending model, right, where there are terms and conditions around securitization that RBI has laid out. I think for 100-0, it seems fairly clear, right? What is RBI's stand on that? I'd also take one question, which is regarding a cash-free product here. So there is a founder of a startup called Flight Messenger, and they offer incentives to their users. They're using the payouts product. Does RBI policy affect us? So just a quick answer is that if it is not lending related, if you are not doing any disbursement of loan or anything as part of the loan journey, then there is no challenge. Payout as a product can be absolutely used. Of course, it is part of the lending journey, then the intermediary wallet that you're using is not okay, right? So happy to take this offline and to reach out to us, and we'll be happy to discuss this as well. Coming to one more question with respect to usage of PAs. Sushil, so this question is to you, right? So the question is, can LSPs pass transaction instruction for split payment when they are taking repayment from customers? So this is a question, I think, with respect to somebody who might be using a split payment structure, right? So how do we interpret it as a PA? In case the LSP is a regulated entity, so in which case, let's say it's a co-lending, versus if it is a 100-0, where the LSP is not putting in any funds of their own, right? So could you help give us the interpretation from your end?
Yeah. So, I mean, our interpretation is largely based on the same conversation which we're having, which is like 100-0 model, or right. So if it's pure LSP where there is 100-0 model.
Sushil, sorry, your voice is fluctuating a bit. Maybe you can switch off your video and Sushil, can you hear me? I think your network is a bit patchy. You can switch off the video and speak. Yeah.
Am I clear?
Yeah, it's better now. Yes.
Okay, sorry. So I was just saying that, from our point of view, the at least the point of view we have today is, going back to the couple of points which were related to FLDG and 100-0 split altogether, right? So from a PS standpoint, we have a position that, if it's an LSP that's doing a 100-0 loan, technically it doesn't need a split kind of a model. It can directly onboard the lender or the NBFC as one of our merchants, and they act as a technical service provider like they are doing for any other activity for the lender. So that's our viewpoint. For a co-lending model where one of the originators also is a regulated entity, that's where some of these models can come into play, which can be a little more customizable for the co-lending kind of a model. But if it's a pure LSP, we are of an opinion that it should be a regulated entity that should be our merchant.
Great. Thanks for that clarification, Sushil. One more interesting question. This I request Push to answer. This is basically on the insurance angle. So please throw some light on what the RBI means on insurances linked or integrated in loan products, as these charges are intrinsic to such loans. What type of insurances are allowed in light of this FAQ?
Okay, so it's like this. So insurance as such, first and foremost thing which I would like to clarify is insurance is not a must buy. It's not that your loan will not get sanctioned if you are not taking the insurance, right? It's just the cross-sell of the product which happens to the customer. Typically, if, let's say RE is in the business of lending or of, let's say, a home loan, they will try to do a cross-sell of property insurance altogether, right? So insurance as such is not must, which I would like to clarify to the audience. And the customer has the option to opt for the insurance. There will be some of the REs who will come back and say, "Okay, boss, okay, if you take insurance, your ROI will go down." No, it's a purview of RE to charge the pricing as long as they are upfront about it, right? The other thing which RBI has clarified about the APR rates, so whether the insurance premium which is getting collected for any insurance which is opted by the customer, whether it has to be part of the APR. Yes, it has to be part of the APR displayed to the customer upfront before he gives a consent to go ahead. So the customer needs to know what is the insurance premium that he is paying for, what kind of insurance that he is taking, what are the benefits of those insurance. So yes, it has to be clearly defined to the customer. Customer needs to give a consent, and this consent has to be auditable. So if at all RBI comes and audits any of the RE, that whether you have taken a consent from the customer for this insurance, RE should be able to produce that. So I think I'm able to give a bit of clarification.
Yeah, thanks. That really, I think, helps people understand how to structure, the insurance piece in the APR as well. Thanks a lot, Push. So there's one more question. This is regarding PA, so I'll pick it up. It says earlier PAs were using virtual account concept and now they're using connected banking. What is the difference in that? So clarifying here, virtual account is virtual account by itself. It can be both in the repayment and disbursement flow. I think in this particular question, what we are talking about, what the the person Manish Shukla is asking is about the disbursement leg, right? So earlier you could use wallets, payout wallets to any basically where the RE or the LSP would recharge the wallet and then initiate disbursement. But after the DLG, so the reason why there has been a change here is because it's a disbursement leg, right? And in the disbursement leg, we are not acting in the capacity of a PA, we are acting in the capacity of a TSP, right? Which is where we are enabling disbursement for you, which is why the a pass-through account cannot be used here. So a pass-through account here would be, let's say, a nodal or an escrow of a cashier or, a PA, basically. So earlier, hence before DLG, because the money movement, there was no restriction around the money movement being via an intermediary account, which is why a wallet could be used. But after DLG, after the September guideline came out, the method that is recommended is to enable a direct disbursement from the lender to the borrower, so from the lender's bank account to the borrower, while the PA can provide the services of a TSP where you use connected banking. So instead of actually doing the disbursement from the net banking of the RE's bank, they can come to the dashboard of the PA or integrate the APIs of the PA to initiate, but the money will always move from the lender to the borrower and not via any nodal or escrow of the PA, right? So that's the clarification on. I hope that helps answer that question. There's one more very interesting question, and then ask Ankur to give your view on that. So I think since we were talking about FLDG and the challenges there, one of the attendees has posed a question: do you see a withholding of payouts from the RE to the LSP based on performance KPIs? Could this be an alternative for FLDG? So basically, what are the alternatives in terms of figuring out the partnership between RE and LSP? That's basically one alternative that they have suggested. What's your view on that?
See, RBI is very clear that there could not be an alternative as far as the FLDG is concerned. FLDG has to some or the other way move out of the decisioning of the loans that they disbursed, right? I think one of the alternative, as I said, at least in the supply chain finance, wherein the money is coming in from the buyer and not from the borrower, right? So typically, a lender would disburse the money to the end supplier, which is your primary borrower, and the money is coming in from the buyer, which could be a corporate, could be a large entity, could be a large enterprise, right? So some or the other way, there could be an option of underwriting or probably taking a comfort on a larger entity, which is driving this entire anchor program, or probably on an LSP or a marketplace, which is driving this entire program with the lender. So again, FLDG is not something which is going to be the case out here. It has to be a risk call being taken, shifted from, say, borrower, which is a small supplier, to a larger buyer, wherein they have the appetite of giving such kind of guarantees or probably giving such kind of confirmations on the payments. So that's one way we can look at it. But again, this is silent as of now. We will have to wait for the RBI to give a clarification around this, that some or the other way, this risk has to shift from X to Y. The risk cannot be zero for sure.
Got it. I think
that is something which is very much clear. RBI had been predominantly very clear that regulated entity has to take a risk. And so there should not be a way out. Frankly speaking, there should not be a way out. As long as you are trusting on the data points and then you are able to work out a lending model altogether for the customer, why should RE be asking for FLDG? So it's as simple as that, right? So there should not be a FLDG as such. I mean, that's my thought process as such.
Great. Thanks, Ankur and Pushp. I think that standing seems very clear for both the RE and the NSP that it is the RE's core job to underwrite. So that cannot be outsourced in any way, directly or indirectly. I think the word indirect control also alludes to that. It's been used twice in the FAQ, so I think that's very important. RE has to be in control. So there's one more question. So basically, again, a co-lending always comes in a discussion whenever we are talking about FLDG and the challenges, etc. Right? So in case of co-lending, so here's one specific question from Nishu. In case of co-lending between two REs, so one RE acts as a servicer, so basically the originator, right? In such case, would it qualify the originator RE or the servicer RE, as they're calling it, as the LSP? And does this limit access to customers' data for that originator RE?
So my take over here is keeping in mind the originator RE is let's say RE in nature. When we talk about the access to data, do the person needs to so the question is whether they would be having the access to the repayment data of the customer or the performance history of the data. Look, when you get into agreements, even in 100-0 kind of agreements altogether, there is a bit of collection angle always involved, even if this is a partnership between the two REs altogether. And somebody in the previous thing asked about what could be the way out of let's say FLDG or something, or the alternative for the FLDG. I think what has come in way is about the payouts being linked to the overall collection portfolio or the efficiency altogether, as long as it is clearly defined in the SLAs that the RE which is acting as a LSP takes care of the collection responsibility to some extent, to certain buckets altogether. So, so yes, they would definitely have access to the data wherein they are responsible to get the collection done for whatever buckets that they have agreed upon in their SLAs with the other or the major RES.
Got it. Absolutely. Thanks, Push. This is a question related to payment aggregators. So Sushil would love to get your thoughts. So the question here is that if PAs are allowed to do the settlement and acquiring, is it also allowed to work as an LSP? Since there are entities which are doing DC EMIs and are PAs and are not LSPs. So I guess this question is around debit card, the EMI schemes that we enable, or credit card EMI scheme that we enable. Does that get construed as an LSP if a PA is enabling that? Do give your view, and I'm happy to give mine as well.
Yeah, I think it's been clearly mentioned in the FAQ as well, right? That debit card EMIs will fall under the DLG. Having said that, I think from a PA's operation standpoint, we don't see any change in terms of, the PA can stand alone. Here, the job of PA is just to enable the fund movement. In this scenario, we don't see any change in terms of how we operate. But yeah, I mean, I think that's been clearly called out that debit card EMI will also be under DLG. So this will apply to, I guess, the providers of that debit card EMI options. Right. So from that perspective, I think from PA standpoint, at least we are clear that we should be able to handle that.
Got it. Thanks for that clarification, Sushil. So there's one question regarding, and this I'll request Ankur to give his view and then Push to also add on. This is about the recovery of defaulted loans, right? So there's one question that clarifies how that is to be handled. So the question here is a slightly long question. It says for recovery of default loans, RBI has allowed cash collection routing through the agent account. Right. So assuming LSP can act as a recovery agent, can digital collections of recovery proceeds from anchors, brands, or liquidation of security for defaulted loan, can they be collected in LSP's account and then passed on to lender? So I think, the simplified question here is that can LSP's account be used as an intermediary if we are talking about collection of default loans, basically?
So I think that's pretty much clarified by RBI's FAQs that this can be done with some ifs and buts. Typically, those ifs and buts would be the borrower should be knowing that these are the authorized agents on behalf of the regulated entities, which are going to do the collection. Now, that entity could be an LSP, that could be a recovery agency, that could be anyone who does the collections, right? I think most importantly, what RBI wants to emphasize on is that has to be a auditable trail log mentioning the entire movement of the money from the recovery agency to the LSP or to the regulated entity. Unless that visibility is not there, I think this will still be not the right way or right approach to get into those kind of recoveries and those kind of repayments from a third party entity. So until the time you have developed those kind of capabilities, tech capabilities in terms of giving the audit trail logs to the RBI or to the regulated entities, I think this is completely okay with RBI moving ahead with the at least from the recovery part or from the repayment part. Push can add on this.
Push, your view on that?
Yeah, so I think my view over here is slightly different in terms of the corrections. So one core thing which DLG guidelines predominantly talks about is the repayment coming in from the customer directly to the RE. There is something which is related to the cash collections, I think which RBI has clarified primarily as such. What happens in case the customer is not able to make a payment to the account of RE, he is not able to do a transfer, UPI, whatever. In that case, if the LSP collects the payment in the mode of cash, how does, so whether the LSP can collect the payment in the form of cash. So that's where I think RBI has clarified that yes, they can collect the payment in the form of cash, as long as the customer gets a confirmation that the cash has been received and the statement of account of the customer clearly shows that the repayment of that particular amount has come in the form of cash altogether. So as Ankur has rightly pointed out, it has to be a auditable trail. But I'm not sure whether the customer can transfer to the LSP's account. I think what one clarity which was there for predominantly is for the cash collection as such. And the larger picture of the DLG stands that the customer has to make a repayment to the RE's account altogether. So yeah, that's something which is my understanding as such at this point.
Got it. Thanks so much, Push. There's one more interesting question again, FLDG being the flavor, it says, so what if, I think here they're talking about co-lending. So technically the LSP here is the originator in the co-lending, right? So does that mean an LSP can provide FLDGs to their co-lender whose contribution is more? So question here is, can an originator provide FLDG to the lender where let's say it's a 80-20 transaction?
So let's say co-lending can be done between the regulated entities. It can't be between the LSP and the RE. So as long as the dealing is or the players are the REs, there is a room for FLDG, keeping in mind predominantly you end up agreeing on a joint policy as such. And predominantly the RE, which is acting like a LSP in terms of sourcing, underwriting and collection, is the front end to the customer altogether. And in those kind of scenarios, predominantly the repayment also comes into, let's say, the RE which is front ending. And keeping in mind it is a RE, RBI allows it. So yes, but if it is a 100-0 kind of arrangement between a LSP, which is a non-regulated entity, and a regulated entity, then in that case, FLDG is totally no. So you just can't have FLDG in the game. And that's the crux. So RBI wants to remove this FLDG as a concept coming in between the LSP and the RE. The risk remains with RE as such.
Got it. Absolutely. So anyway, if it is, a co-lending use case, then they both are regulated entities. So securitization to the extent of, the money being put in is allowed. But if it is 100-0, then you're not a regulated entity. So there, the risk cannot be basically transferred to TLSP. Right? So that's the writing. So I think there was also, a discussion in our last webinar around this, that does that mean that a lot of LSPs will move towards becoming regulated entities themselves? Of course, it has its own set of challenges. Acquiring a license or basically applying for a license has its own set of challenges. But do you see that as the direction that things are going to go?
Look, bringing in removing the FLDG is basically, let's say, is a good thing for LSP altogether. They don't have to block their money. It's a good thing for LSP. In terms of revenue sharing, I think LSP ends up making the same or similar amount of revenue, even if they are not participating in the form of FLDG altogether. I don't see a reason why any LSP should want to get into a NBFC play altogether unless they see a lot more value in terms of coming up with different products altogether. So let's say as long as the LSP is a product or a segment specific, it will be great if at all they keep on improving and make it more efficient altogether and create a niche for themselves. To get into an NBFC mode, to provide FLDG kind of thing doesn't make sense. Your revenues are not hit, right? The only challenge which comes up between the RE and the LSPs at this point of time was that, and I'll be very transparent, and is that there had been a lot of push earlier for the model prepared by RE to underwrite basis FLDG. I think that is something that RBI doesn't want. RBI wants, boss, you are RE, prepare your own lending model basis the data points that you have from the LSPs coming.
Got it. Absolutely. So I think, again, basically we took a bunch of questions on FLDG, but I think from all angles, the writing is clear, right? I know that there were a lot more questions, we won't be able to take all of those because we have run out of time. But what we will try to do is, for the folks where we, have the connects where, we can see the names, we will try to get responses from the panelists and come back to you as much as possible. But thank you, everybody. I hope this was helpful for answering a lot of questions. Push, Ankur, Sushin, thank you so much for sort of, clarifying things and giving very straightforward answers. I think that's really important at this point because, it has long-term implications overall for the ecosystem to understand not just what the RBI is saying, but what is the spirit of what the RBI means, right? So that's super important. So thank you so much. And thank you for everybody for joining in. I apologize, I couldn't I tried my best to get as many questions answered, but we will try to maybe have more follow-up sessions to take up more questions as well. Thank you, everybody. Have a great day.